Welcome to The Explainer. Today, we're going to tackle a question that, let's be honest, pretty much every single options trader asks themselves at some point. You've placed a trade, the market moves, and you start wishing you could just tweak that contract a little bit. So picture this. You've placed your trade, the stock starts moving, and you're thinking, man, I wish I had a different strike price. You're kind of looking for an edit button, right? A way to just go in and change that number. So is there one? Okay, let's just rip the Band-Aid off. The direct answer is a big, simple no. An options contract is a binding agreement. Once that trade is executed, its terms, including the strike price, are locked in. They are set in stone.
But hold on, don't worry, that's not the end of the story. While you can't hit an edit button on your existing contract, there is a standard, widely used strategy that traders use to get the exact result they're looking for. All right, let's really dive into this dilemma because it happens to all of us. What do you do when your trade moves? How do you handle it?
Well, the solution isn't about changing your current trade. It's about replacing it. And this strategic move has a name. It's called rolling. So how does it work? It's basically a two-step move. First, you close out your original position. Then, at pretty much the same time, you open a brand new one with the strike price you actually want now. And when you do both of those things together, yep, that's a roll.
I love this analogy. Think of it less like editing a document and more like trading in your car. You can't just call the manufacturer and ask them to swap the engine in your current car, right? No way. You have to sell the old one and buy a completely new car with the features you want now. It's the exact same idea here.
Now, this brings up a really good related question. If a trade is going your way, why not just exercise the option early and lock in that price? Well, there's a huge reason most traders avoid this, and it all comes down to something called time value. First, a quick sidebar. You've got two main flavors of options, American and European. American-style options, you can exercise them anytime before they expire. European ones, only at the very moment of expiration. But here's the really interesting part. Even though American options give you all that flexibility, traders still rarely exercise them early. Why is that? Yeah, so why would a trader pass up the chance to exercise early if the trade is a winner? What's the catch? What are they giving up? The answer is time value. You see, an options price has this built-in premium. It represents the potential for it to become even more profitable before it expires. When you exercise early, you forfeit all of that remaining value. You are literally leaving money on the table.
So, and this is the really crucial part, it is almost always more profitable to just sell the option contract to another trader. That way, you capture not just its real value, but also all of that juicy time value that's left over. Okay, let's build on that. To really get this, we have to talk about the concept of moneyness. This is what helps you decide if an option is even a candidate for exercise in the first place. Yeah, moneyness is just a fancy word for a simple idea. It describes the relationship between your option's strike price and the stock's current price. Basically, it answers the question, would this thing have any value if I exercised it right this second?
And this chart here illustrates it perfectly. So look at example 1. You've got a call option to buy stock at $45 and the stock is trading at $50. Boom, you are in the money. But now look at example 2. The stock's at $40, your option is now out of the money. And you see that $5 difference in the first example? That is what we call intrinsic value. It's the fundamental real-world profit that's baked into your option right now.
Now, an out-of-the-money option, it has zero intrinsic value. I mean, think about it. Why on earth would you use an option to buy a stock for $45 when you could just go buy it on the open market for $40? It makes absolutely no sense, which is why it pretty much never happens.
All right, so after all that, what are the most important things to remember? Let's recap the whole thing. Okay, here are the core principles. Number 1, an option's strike price is fixed. You can't change it. Number 2, to adjust, you have to roll it. Close the old one, open a new one. 3, exercising early is usually a bad idea. And why? That brings us to number 4, time value. You give up that extra premium when you exercise early instead of selling the contract.
And you know, this brings us to the next level of strategy, something for you to think about on your own trading journey. We've just covered the mechanics of how to roll an option. But the real question, the real art of trading, is knowing when is the right time to do it.